Today, we're looking at a high-energy financial analysis arguing for a 50% upside on Rigetti Computing, RGTI.
Yep.
It's driven by its cash pile, analyst targets, and new tech. So let's dive right into the analysis of Wall Street bullish on RGTI, why 50% gains are coming.
Okay, so I'm impressed by the enthusiasm here. I mean, the core catalysts are clearly identified.
It's timely.
Very timely, and it captures the market momentum well. The challenge now is to elevate it, to take it from just a strong conviction piece to something that feels more like an authoritative financial assessment.
Right, because if you're building a case for a 50% move, that foundation has to be just unshakable.
Exactly.
So let's get into our first area, which really deals with that structural completeness and investor perception. So while the report effectively highlights major tailwinds, integrating a concise assessment of potential risks would significantly bolster the credibility and completeness of the financial analysis.
That's it. That's the essential first step toward authority.
Mm-hmm.
Look, where the material falls a little short right now is in presenting this intensely bullish, one-sided view.
Yeah.
In any kind of sophisticated financial analysis, that risks overlooking, the crucial counterarguments that seasoned investors are actively looking for.
They're trained to look for them.
Exactly. The weakness here is subtle. So, for example, drivers like the $500 million cash pile are presented only as this unassailable runway.
Right.
But there's no simultaneous acknowledgement of the massive cash burn required to actually execute on a roadmap like the 100-plus qubit era.
That seems a little counterintuitive, though, right? If you're trying to sell the upside, why would you deliberately bring up the downside?
Because neglecting the obvious risks doesn't make them just vanish. It makes the analysis look incomplete.
Okay.
A sophisticated reader immediately asks, okay, what's the cost of that runway? If the analysis doesn't address the burn rate, it just looks like the author hasn't done all their homework.
Ah, I see.
You're basically using the presence of risk as a rhetorical tool. By addressing it, you show that your bullish thesis has already accounted for and can withstand those challenges.
So the move is really to demonstrate that due diligence has been done. We're using a small section on risk to actually boost confidence in the upside by proving the analysis is comprehensive.
Precisely. The suggestion is to allocate a small, focused section, and we're talking efficient, sharp language here, to address the most pertinent counterarguments.
So not a huge section.
No. This doesn't dilute the conviction at all. It proves the analysis is robust. It moves the report from feeling promotional to feeling like a well-rounded institutional assessment.
And we need some concrete, usable language for this. We can't just sort of wave our hands at risk. It has to tie back to those three core drivers.
Absolutely. You have to introduce the flip side of those drivers. So for some concrete examples, instead of just celebrating the runway, you could pose a direct challenge to the execution.
Okay, like what?
Something like, what are the major execution risks associated with delivering the 100-plus qubit high-fidelity era, considering, the historical challenges in scaling quantum hardware?
Right, and maintaining coherence.
Yes. Or, focusing on the valuation part, you could ask, how does the current $7.8 billion valuation compare to its peers after you adjust for the high burn rate and the time horizon to profitability?
Instead of just saying market cap is catching up.
Exactly. By framing the risks as execution challenges the company must overcome, you actually make the achievement of that $35 target seem even more valuable.
That one small addition of balance, it just fundamentally changes the nature of the piece for the better. It takes the argument seriously by showing mastery over the downside.
It really does.
It just shifts the whole tone towards authority.
Absolutely. And once we've established that solid risk-aware foundation, then we need to look at the scaffolding itself. The next area is how the material builds the bridge from, say, qualitative promise to quantitative reward.
Okay, so the connection between the three bullish points, the cash, the roadmap, and the valuation gap, and the specific 50% price target of $35 is asserted rather than fundamentally established. It leaves the critical why behind the target a bit undersupported.
This is a structural necessity for any compelling financial argument, especially when you're arguing for a defined 50% move.
Yeah, you can't just pick a number.
Right. The material is great at listing the reasons why Wall Street is bullish. The promise is clear. But I'm left wondering, why $35? Why not 30 or 45?
Right.
Articulate the mechanism. How do these qualitative success factors, like hitting the 100-plus qubit milestone, how do they translate into a specific quantitative valuation increase from the current price?
It feels like the price target is just being treated as a given. Like, oh, the analysts agree, but we're not showing why they agree using the analysis's own strong fundamental points.
That's it.
We're missing that foundational logic that connects a technical achievement to something like a market multiple expansion.
Exactly. And in deep tech, that's everything. The market rewards milestones with multiple expansion. When a company hits a major technological inflection point, let's say moving from a research phase to a commercial scaling phase, the multiple it trades at fundamentally changes.
And that's what drives the price.
That change is what causes the price target shift.
So the core suggestion then is to strengthen that logical flow. You have to explicitly bridge the gap between the drivers, the tech, the financials, and the valuation model that justifies the target. We need to actually show how those factors justify closing that valuation gap to $35.
Precisely. We need to define the impact of execution on valuation.
Okay.
So when we talk about multiple expansion, what we mean is the market assigns a much higher value to each dollar of future revenue because the risk profile is going down and the commercial opportunity is going up. That mechanism is sort of implicit right now, but it needs to be explicit to justify the $35 number.
So how do we anchor that specific number more firmly without, writing a whole DCF model in the middle of the report?
Well, you can use concrete examples to make that causal link really undeniable. You tie the execution directly to market perception.
Okay.
Instead of just listing the reasons, you integrate a statement that connects the tech execution to the valuation shift in quantitative terms. For example, you could write something like, achieving the 100 plus qubit era is projected to justify a market multiple expansion of 1.5x,
I see.
aligning RGTI with peers and thereby closing the historical valuation gap to the $35 level. That's a very concise, actionable link right there.
That's a really effective way to do it. You're connecting the tech breakthrough to the specific multiple expansion you need to hit the target. It gives the argument an analytical backbone.
Or you could use the highest analyst target to frame the justification for the consensus 35.
How would that work?
You could say something like, the street high target of $50 is contingent on the full monetization and mass adoption of the 100 plus qubit roadmap.
Okay.
The $35 consensus, therefore, reflects the highly probable scenario of partial execution success, or something like success achieved on an accelerated timeline.
That anchors $35, not just in what Wall Street thinks, but in a defined stage of the company's execution.
Exactly. That kind of clarity is what separates a compelling call from an arbitrary assertion. It tells the reader the number is derived from a defined goal, not just momentum.
Okay, so moving from that structural logic to the presentation itself, how the analysis is packaged, our final critique moves into how the language impacts the perception of the work's depth.
And this is a critical step for making sure the high-level insights are taken seriously by, say, an institutional reader.
The reliance on high-energy, trader-focused language, while engaging for a video report, may inadvertently detract from the analytical seriousness implied by citing specific analyst consensus and technological roadmaps.
I get why the author used this language. I really do. It captures the excitement of Wall Street bullish and that feeling of momentum.
Right.
But the weakness is that phrases like buying the rip, bear trap, and screaming bull flag breakout, they all strongly emphasize very short-term trading signals.
Mm-hmm.
And this high-octane vernacular works directly against the broader argument in the piece, which is focused on longer-term, fundamental drivers, like the $500 million cash runway and the multi-year quantum roadmap.
I was going to defend the excitement. Isn't that conviction part of the appeal?
Conviction is absolutely essential, but it needs to sound institutional when it's backed by a massive cash runway and multi-year R&D.
Okay.
The disconnect creates a kind of cognitive dissonance. One section sounds like a rapid-fire day trading call, while the fundamental section is focused on multi-year institutional investment.
So the goal isn't to kill the excitement.
No, not at all. It's to frame the technical signals not as the reason to trade, but as the confirmation that institutional money is finally starting to agree with the fundamental thesis.
I see. So we're shifting the emphasis from the thrill of the immediate trade to the significance of that institutional conviction. How do we make the technical analysis support the long-term view?
The suggestion is to just calibrate the tone. We need to make sure the technical commentary supports the fundamental thesis. Make the language more institutionally aligned when you're discussing things like institutional accumulation or key support levels.
Okay.
This aligns the tone with the sophistication that's already in the rest of the analysis. You want the technical breakout section to be seen as the market finally validating the long-term story, not just a momentary burst of hype.
Okay, so let's focus on the impact of that language change. What's the real difference between saying buying the rip versus observing an institutional confirmation?
Well, buying the RID implies you're just chasing short-term momentum.
Right.
Institutional confirmation implies sustained interest because large players have done their own due diligence and are now establishing long-term positions. Your analysis is fundamentally a long-term story about a tech inflection point. The language has to reflect that patience and that conviction.
This is where those concrete examples are so vital. We need to keep the excitement of the breakout, but use language that sounds more measured, that emphasizes that long-term conviction.
Absolutely. So, when you're describing the technical breakout, you rephrase the sentiment to focus on confirmation and institutional participation.
Okay.
Instead of the current phrasing, which says the stock never looked back after breaking 22, which is a bit hyperbolic.
Yeah, a little bit.
Try focusing on the momentum confirmation, something like the decisive break and subsequent hold above the $22 resistance level, followed by the strong close near the $24 daily high, provides key technical confirmation of institutional conviction.
Aligned with the consensus target.
Exactly. You keep the factual event of the breakout, but you use language that emphasizes long-term conviction over short-term flips. It demonstrates that the technical action and the fundamental valuation are finally harmonized.
And that ties the technicals back perfectly to the $35 consensus target. The technical action is just evidence that the institutional belief in the roadmap is finally gaining traction.
Exactly. When the language